Hello everyone, welcome to the session. I am CA Manu Goyal, your mentor for US CMA Part 1 Section A External Financial Reporting Decisions. So let's start the session and discussion. So our topic under the external financial reporting decision, the first topic is financial statement. Before moving to the financial statement, let us first understand the base of financial statements, that is accounting. So what is accounting? Before understanding accounting, we have to understand two terms, transaction and event. Now what is transaction? What is event? Transaction, the meaning of transaction is that any performance under a contract or an agreement is known as transaction. Okay, so any economic activity or performance under a contract or an agreement is known as transaction. So let us understand, there are two entities, Mr. A and Mr. B. If A wants to purchase from B, he is the buyer, he wants to purchase dry fruits like almonds 100 kg, and he asks B the rate. The B gives the rate of 700 rupees per kg. 700 rupees per kg, and A wants to buy 100 kg of almonds. Now A agreed with the price, and B and A enter into a contract or an agreement that A will buy the almonds and will pay 700 into 100, that is 70,000 rupees to be 70,000 to be, and B will provide 100 kg of almonds. So the right of A is to receive almonds, and A's obligation is to pay 70,000 rupees to B. B's right is to receive 70,000 from A, and obligation of B is to deliver 100 kg of almonds. So this is a agreement, and if it is legally enforceable in the court of law, that becomes a contract. Now in this contract, both A and B have rights as well as obligation against each other. So this is an agreement, and if A makes the payment and B supplies the almonds, then we will say that there is a transaction between A and B. For A, this is a purchase transaction. For B, it is a sale transaction. Okay, so performance, that is supply of almonds by B, is the performance, and A makes the payment, that is a performance by A. If both the party performs their obligation under the contract or agreement, that is known as transaction. So example of transaction can be purchase of goods or services, for sale of goods, payment of salary or wages, and payment of rent. So all these are transactions. Now tell me whether the transaction would be voluntary or involuntary. Transaction will be voluntary always. Will always be voluntary. Why? Because when both the parties are consented, then the transaction can occur. So transaction is always what? Voluntary in nature. Now, what is event? Event means any happening which can be either as a result or consequence of many transactions, or which can be involuntary in nature, which can be time based. It can be a time based happening. It can be a uncertain sudden happening. So event is a happening which can be a result of transaction, which can be involuntary in nature, which can be time based, or which can be uncertain sudden. Loss of inventory, suppose there is theft by robber in your factory. So loss of goods by theft is involuntary in nature. It is a happening which is involuntary because business don't want to have theft in their business. No one wants to have theft in their business. So it is involuntary. It is a happening. So loss by theft is a event. When you purchase goods, sell goods, and you incur some expenses for the business, suppose your all the expenses and purchases are for 5 lakh rupees and you make a sales of 7 lakh rupees. So 2 lakh is the profit. Purchase, sale and incurring other expenses are all transactions. So result of these transactions is what? Profit or loss. So profit or loss is a result of many transactions. Okay, so this is all also known as event. Now depreciation fall in the at the end of each accounting period, when which is usually 31st March or 31st December. So at the end of each accounting period, we charge depreciation. We will later on we will have a detailed discussion on this later on, that what is depreciation. Depreciation, we charge expense on the fixed assets, tangible fixed assets, that is known as depreciation at the end of each accounting period. So that is also a event because it is time based. When 31st March came, when balance sheet date came, we charge depreciation. You purchase goods, that is a transaction. You sell goods, that is a transaction. But you purchase 10,000 units, you sold 8,000 units, but you are left with a closing stock, closing inventory of 2,000 units. So this closing stock at the end of the reporting period or accounting period is a result of purchase and sale, that is a transaction. So closing stock is also an example of event. So event are involuntary in nature. Are you clear with this? What is transaction? What is event? Let us discuss an example to elaborate more on the transaction and event. Suppose there is Mr. Sam. Mr. Sam invests rupees 5 lakh rupees for running a food grain trading business. On 1st April, he purchases goods for 3,15,000. He sells goods for 5,47,000 among these goods which were purchased. Okay, during the month of April, he pays shop rent for the month of April 15,000 rupees, and he still finds that at the end of the month he has goods worth rupees 65,000 rupees with him at the end of the month April. Now we can calculate the profit. Now what was the sale? 5,47,000. We have closing stock 65,000. We have what? We have purchases and shop rent. We have purchases of 3,15,000. And we paid a shop rent of 15,000. Okay. Now what is the profit? Now this is the revenue. This is the closing stock. So the total is, what is the total for this? This comes out to be 2, 1 carry, 1, and this is 11 and 1 here. 6,12,000. Out of 6,12,000, 3,30,000 is the expense. Yes or no? So what is the profit? What is the profit? 2,70,000 plus 2,82,000 rupees is the profit. Yes or no? Now this sale is a transaction. Yes. This is a event. Yes. This purchase is a transaction. This rent paid is a transaction. Now this surplus is a result of these transactions. So this is an event. Hope you can understand. So event can be the result of many transactions also. Now we are done with transaction and event, the base of accounting. Now there is a very famous authority, that is American Institute of Certified Public Accountant in USA. In 1961, this AICPA gives the definition of accounting. According to AICPA, accounting is the art. Okay, it is the art. Why it is art? Because it depends upon the creativity, skills, and the knowledge and experience of each accountant, how beautifully, how creatively he applies the accounting principles while making the accounting treatment of transaction and events. So accounting is an art of recording, classifying, and summarizing what? Summarizing transaction and events which are of financial character. Now what is financial character? Financial character means they can be expressed in terms of money, and they should be business related. So if there is any transaction or event which cannot be expressed in terms of money, we will not record that. We will not classify that. We will not summarize that. For example, if there is a birthday of founder or the promoters of a company, then it cannot be expressed in terms of money. Joining of it is an event, but it cannot be expressed in terms of money. Suppose a particular employee, a very honest employee, a punctual employee joins the organization, so we can't give a monetary tag to his loyalty or punctuality or sincerity or efficiency, so it will not be recorded. Okay, it should be business related. That means if you buy some grocery for your own personal purpose, that will not be accounted for. Okay, so there are two conditions, that each transaction, only those transaction and event which can be expressed in terms of money and which are related to business will be accounted for. Okay, so we record, we classify, we summarize transaction and events which are expressed in terms of money and which are business related, and then on the basis of this we get what? We get financial statements, and these are the end product of accounting. These are known as the end product of accounting process. So these financial statements, we interpret the results given in these financial statements, and we do analysis and we communicate the information. In 1966, American Accounting Association gives a improved version of accounting definition. It adds certain things to this definition. So it states that accounting is a process of collecting accounting information, then recording accounting information, then classifying, then summarizing, and then after interpreting the results, we have to communicate this accounting information to the users so that they can make their judgments and they can take their decisions. So let us discuss in detail the accounting process. So first step in the accounting is to identify the transaction and events which are of financial character, means which are in terms of money and which are business related. So how we will identify transaction and events? For identifying transactions, we must have some documentary evidence, and that documentary evidence is known as voucher. So we identify transactions on the basis of voucher. Voucher is a documentary evidence which gives the evidence that a particular transaction has occurred. So for purchase, we have purchase invoice. For sale, we have sales invoice. Issued by the seller. Purchase invoice is obtained by the purchaser from seller. And for salary, we have the employer issues salary receipt. For payment of rent, we get the rent receipt from the owner of the property. So this is just a demo. This is just an example of a voucher invoice, that in a particular invoice, sale invoice, there is the company name, okay, its details, then this is the buyer information, this is the invoice number, this is the date, this is the customer ID, these are the terms, these are the description of the services or material provided, this is the quantity, unit price, amount, and there is further details can include discount and the tax rate applicable and the total amount payable. So this is a voucher. So first step is clear, that we identify the transaction and events on the basis of voucher. Second step in accounting is recording. So how, after identification, we have to record the transaction and events in a book known as journal. So journal, first of all, we record the transaction and events by passing general entries in a document known as journal. That book is known as journal, and these entries are later on transferred to secondary books known as ledgers or accounts or subsidiary books. Okay. So this is how we will discuss this later on, that how we pass the journal entries. So these are the example of journal entries. You can see that if the owner brings the capital into the business, introduce some money into the business, then we pass cash account debit to capital. When we purchase furniture by paying cash, so we have entry furniture to cash. So this is the journal and these are the journal entries. Now later on, these journal entries are posted into the accounts, the summarized records, that is known as ledger. So that is the third step, that posting of transaction and the journal entries into the ledger is the third step, that is known as classification. So we classify items into the 5 heads, that is the asset, liability, revenue, expense and equity. These are also known as 5 masters of accounting. Okay, so according to their characteristics, each transaction and events are classified into the 5 heads: income, expense, assets, capital and liabilities according to their characteristics. So we post those journal entries into the ledger. Then we have the fourth step, that we summarize these accounts. We make a summary of each ledger or accounts, that is known as trial balance. So summarization includes what? Preparation of trial balance as well as profit and loss as well as balance sheet. So in summarization we have 2 components, trial balance and preparation of financial statement. In financial statement we have many components: balance sheet, cash flow statement, profit and loss account or statement. So this is the summary. So for some accounts we have debit balance, for purchases we have debit balance, for assets we have debit balance, for stock which is an asset we have debit balance, for sales which is an income we have credit balance. Then we will discuss all these in detail. This is just a summary to explain you what is accounting. So in financial statements we have balance sheet. So balance sheet shows that what are the assets, from where, what are the asset and what are the liabilities. Asset shows what are the resources a business owns or controls. So these includes further categorized into short-term assets and long-term assets. So short-term asset, current asset; long-term asset, non-current asset or fixed asset. Liabilities and equity shows from where, for purchasing these resources, for acquiring these resources, from where you arrange the funds. So this side shows the sources of funds. So this is a horizontal balance sheet. This is a horizontal format because we go like this. We present here. So this is a horizontal format. Okay. This is a vertical format. In vertical format, we show sources, then we show the resources. This first this is the vertical format because it is arranged like this. Okay, so first we have the sources of funds, then we show the usage of funds. Okay, so these are the changes in the balance sheet and P&L. Then we have, so balance sheet shows the position, financial position. Then we have the income statement. Income statement shows what? That what are your revenues and what are your expenses. And then from revenue we deduct the expenses, we get what? We get profit or loss. Okay, so this is the P&L account. So here we have the direct expenses and direct income. From this we get the either gross profit or gross loss depending upon the amount of revenue and expenses. Then we have indirect expenses and indirect incomes. Then we get the overall net profit or loss from the business. So this shows the financial, this statement shows the financial performance in terms of profit or loss. And balance sheet shows the financial position. So this is the horizontal format. This income statement can be prepared in vertical format also. First we shows the income, then we show the expenses. From income we deduct expense, we get the profit or loss. Then there is a third statement also known as cash flow statement. Cash flow statement. Now what is cash flow statement or statement of cash flows? It shows the inflow and outflow of cash and cash equivalent investments which are highly liquid from three activities: operating activities, investing activities and financing activities. We will discuss this cash flow statement later on in detail. So this is the fourth step. In the fifth step, we prepare what? We do what? From these financial statement, we have financial statement. In financial statement, we have balance sheet showing the financial position. We have profit and loss showing the financial performance. We have cash flows statement. So from these statements, we analyze various variables: asset, liabilities, equities, income, expenses, cash flows, and we do analysis of different variables, ratio analysis of different variables. So we interpret the variables, different accounting variables related to the business, and then on the basis of that interpretation we do some analysis. That is known as ratio analysis. So this is the, and then in the sixth step we communicate the accounting information that is the financial statements to the users of financial statement or financial information or accounting information. How we communicate the accounting information to the users? In case of a company, there is a document which is known as annual report. In annual report there are many documents, and one of the document is financial statements. So every company annually publishes its annual report, and we include in that report financial statements. When this information is issued in the public domain, annual report is issued to the shareholder, investors and to the other public stakeholders, then they can read the financial statement and they can judge the financial performance, financial position and cash flows of the business. So now we are clear with the term what is accounting. So accounting is an art as well as process of what? Of involving 6 steps. First, we identify the transaction and events on the basis of documentary evidences known as the vouchers. Then in the second step we record. So in the first step we identify the transaction and events on the basis of voucher. In the second step we record the transaction and events by passing journal entries in the journal. In the third step we classify the transaction and events into 5 masters on the basis of their characters by posting the journal entry passed into the different accounts known as the ledgers. In the fourth step we prepare a summary of transaction and events of all the ledger accounts known as the trial balance, and we make financial statements. In the fifth step we do analysis and interpretation through ratio analysis, and in the sixth step we communicate the financial information, that is the financial statements, to the users. So all these 6 steps together constitute the accounting process. Okay, so that's all for today. So bye bye all of you.